Growing optimism over lower interest rates in the U.S. has propelled markets higher during the fourth quarter. On Tuesday, the Dow Jones Industrial Average hit its fifth consecutive record close in a row, and the S&P 500 is just a few points away from a record high of its own. For some thoughts on where markets are heading from here and how best to invest, let's bring in Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Chad, thanks a lot for joining us. You say that you are modestly overweight equities. What takes you there?
So thanks for having me, Paul. Yes, we are modestly overweight equities, and we're tilted in our tactical asset allocation program to more growth-oriented stocks in that strategy. We see that the economy in the United States has a good tailwind, European economy as well, and then you have the credit markets that have been really behaving quite nicely. So, the Federal Reserve, did their Fed pivot last week. That shocked the market at a time when you have full employment and a tremendous amount of fiscal stimulus that will be hitting in 2024. So it should bode well for earnings, at least for the first half of the year.
Did you change your positioning at all in response to that Fed pivot?
No, we were modestly overweight to begin with. We do see seams of opportunity and value in more of the higher quality names that haven't bounced as far as the broader markets. In particular, lower quality stocks shifted higher over the last week and a half, which we would fade that and go into more of the steady Eddie companies.
You're overweight growth versus value, as you've said. Why so? And is that a part of a call on lower interest rates?
Well, what we're looking at are companies that are higher quality names. In our rising dividend portfolio, for example, you can find tremendous seams of opportunity where earnings predictability and revenue growth should be quite robust for 2024 and 2025, even if you get a deceleration in the back half of the year. So look no further as a company like Microsoft or Accenture, for example, as two great opportunities from that perspective.
Talk a bit about Microsoft. Why do you like that one?
So it's in the corner, it's not only doing well on their enterprise software business, but as this big shift towards artificial intelligence starts to, and we remind you, in the early innings, they seem to be one of the leaders. So they'll be able to leverage their partnership with ChatGPT and as well from that perspective, generate a tremendous amount of free, steady cash flow that's much more predictable than many of the startups in that sector. So we are looking out 5 years with Microsoft. Yes, from a valuation perspective, initially from this starting point, it may look a bit expensive, but if you look out from a 5-year perspective, top line growth, we believe, is going to be above 10%. Operating margin improvement will continue to happen over the next 5 years, and they'll have a rising dividend with very little debt and tremendous amount of cash on their balance sheet.
Shares of Alphabet, the parent of Google, are up about 60% so far this year. You like that as well?
Yes, out of the big tech winners of this year, the valuation of Alphabet is quite reasonable. That's in our all-cap value portfolio. Again, another play not only on their advertising business and their YouTube business, but also generative AI. We think that they're going to be one of the winners there. So you have a multiple there, EBIT to enterprise value below 17 times for 2025. Predictability of earnings that is very sturdy, even a decelerating economy. This one, we believe, should be one of the cornerstones for more of an aggressive portfolio, or even a modestly aggressive portfolio. Overall, we favor this one.
And Texas Instruments, you also like. That's a well-known name, of course. It's a stock that I find gets a little less attention these days than it did in the past.
Yes, because it's not on the cutting edge. They're not producing chips that are on the cutting edge like NVIDIA, for example, or AMD. They are producing the chips that go into more industrial auto companies. Those type of chips are not the most sexiest, and you don't talk about that, often, but they're essential. So we believe that Texas Instruments' growth rate over the next 3, 5, 7 years is going to range between 6% and 10%. Margins should improve. They're on right now a tremendous amount of capital spending cycle that should last for the next 4 years. That's what has given some investors concern. That's why you had the pullback that you had this year within this stock. But we think the return on invested capital for what they're doing today will pay off tomorrow. So we would favor Texas Instruments as, again, another rising dividend company with a lot of cash flow growth in front of them in a very predictable type of business line.
We've got about 60 seconds left. Why don't we finish with why you were avoiding oil and gas stocks? That's a bit of a contrarian call these days.
Oh, it is, right. Well, we favor companies that have more steady Eddie free cash flow, that when you look out 5 years, they're much more predictable. And what we see with oil and gas companies is that there's a general amount of fragility when you start to see a deceleration of the global economy. Although we're not predicting it now for the next several months or 6 months, there could be a time later this year or into next that will occur. Also, keep in mind that you have the shale industry here in the United States, where the price point now is much more attractive for them to hit the gas pedal and to provide as much supply as possible. So OPEC Plus is quite vulnerable from that